The reason Bitcoin is winning, the reason that digital capital is winning, is because things that move at the speed of light, friction-free, 24/7, 365 globally, right, that can be programmed by an AI, that can be vibrated or transformed a million times a second, are going to displace, in a brutal Darwinian fashion, right, their slower, clumsier, antecedents or precedents. It's like the things that came before, right, are going to be squeezed out of the economy and out of the marketplace because the thing that comes later is just better.
For most of history, money moved slowly. It waited on bank permissions, business hours, borders, and paperwork, a financial system built on rails created long before the digital world began running at full speed. Yet today, everything operates in real time. Trading algorithms fire in milliseconds, data moves instantly across continents, and industries run non-stop. In a world shaped by velocity, any form of capital that can't move freely, settle instantly, or integrate directly with software starts to feel outdated. The economy is accelerating, and value has to accelerate with it. But Bitcoin, the first truly digital form of money, is now confronting a sharp moment of its own. After reaching record highs in late 2025, the market slipped into a drawn-out downtrend. Prices fell nearly 50% from the October peak and dipped below $63,000 as tariffs, uncertainty, and risk-off pressure rattled investors. Analysts remain divided on whether this is a routine correction, a prolonged consolidation, or the beginning of something deeper, with some technical signals pointing toward potential support in the $45,000 to $50,000 zone if bearish momentum continues. Supporters like Michael Saylor argue that these swings aren't signs of failure, but indicators of a system undergoing competitive evolution. When a faster, cleaner, more adaptive form of capital emerges, it doesn't politely coexist with legacy structures, it overtakes them. And Bitcoin's recent turbulence, far from contradicting that idea, reflects the exact macro forces that accelerate its relevance. ETF outflows, geopolitical stress, and shifting short-term expectations all create the kind of friction that digital money was built to outperform. In that sense, the crash isn't the headline the resilience is. According to Saylor, the same dynamics shaking markets are the ones priming Bitcoin for its next major move, so forget the crash. But if history keeps repeating itself, is Bitcoin quietly preparing the kind of nuclear bounce that only becomes obvious after it detonates? Let's watch more clips from Michael Saylor's latest revelation to gain more insight. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I think that the retail investors that are passionate and committed to digital capital, to Bitcoin, I think they found it already. I think that they've had 10 years to find it. So if you're looking for a non-sovereign store of value, bearer digital asset, I think that sometime between 2010 and 2025, you found it in one of those successive waves. And then you bought as much as you could possibly afford to buy. Okay, and that's fine. I think that if you want to draw the next cohort of retail investors, they don't want a 40 vol, 40 ARR asset. What they want is something more like a 10 vol, 10 ARR asset, or a 0 vol, 8 ARR asset. So I think that the way that we draw the mass of investors is you offer them something like digital credit, like STRC, where we say, well, here's 11%, it's tax deferred, we're stripping the vol off of it. Like the 1 year volatility of STRC is less than the NASDAQ, is less than the S&P index, it's less than gold. Right? I'm going to give you an asset which is less volatile than conventional stores of value, but it's kind of a, it's a certain, right, straightforward, defined 10% or 11%, and you get it monthly. And you can test this yourself, Natalie. I would challenge you to test it. Walk down the street and find 100 people and say, would you rather have 30% a year over the next 20 years, but you're going to get 40% drawdowns and 40 volatility? It'll be 3 times as volatile as the S&P index. And, some years you won't make any money and some years you'll make a lot of money, but it'll be 30%. Or would you rather have a bank account that pays 10%, where you can take your money out whenever you want, but you'll just collect 10% while you're waiting? Now ask them, take the survey. I would think, like, if you were to say 95% of the market wants a 10% bank account they don't have to pay tax on, and only 5% wants the 30% a year, I think that that's optimistic. Like that's probably too pro Bitcoin. I don't think 5% of retail investors want to hold Bitcoin and collect 30% a year tax deferred with a volatility that's double or triple the S&P. Like you might find differently. I would suspect it's possible that number is 1-2%, right? So the great mass of the retail investors, they want something which is 2x or 3x or 4x better than a bond fund. Or they want something that looks like the S&P but without the drawdowns of the S&P. And so we're going to attract retail investors to the ecosystem when we take the best of equity, the best of credit, and the best of crypto, and we put the 3 together. So what does that mean? Equity is double-digit returns and tax-deferred gains. Credit is price stability, principal protection, and low volatility, and a very defined yield, like defined, consistent cash income. Crypto, Bitcoin, is digital innovation, right? Transformation, and 2, 3, 4x the productivity of the conventional economy, right? It's massive growth. Okay, so right now, the retail investor, they have to choose between massive growth and a roller coaster that's pulling 9 Gs.
Right.
That's Bitcoin, right? Or they have to take the S&P or the NASDAQ index and accept 50 to 20 vol with good years and bad years, but over time, 10% ARR or better. Or they have to accept a credit spread from an investment grade bond of 70 basis points, which means they're getting 4.5% interest, and it's fully taxable as ordinary income. So, you're a California resident, you're either getting 2% on your Apple bonds after tax, 2%, but you feel safe, or you're getting 10 to 15% on your S&P and NASDAQ portfolio, but you're getting not much of any yield, and you're on a small, kind of a conventional roller coaster. Or you buy Bitcoin and you're getting 3x the roller coaster ride. You're getting better performance, but for the last 137 days, people think that you're crazy. Right? And so those are your 3 choices. I think that the way that we break that logjam is we simply engineer digital credit. That's why that's been my passion for the past year. Can I actually take a 45 vol, 45 AR asset, which is Bitcoin, and strip 80 to 90% of the volatility off it, strip 80 to 90% of the risk off it, and let's give you something 4 to 5 times over collateralized. Let's create a double-digit yield. Let's do it in a way that's a return of capital, so you get tax deferred, or you get deferred tax treatment. So you get the benefits of equity, you get the performance of equity, you get the principal protection of credit or a bond, you get a defined yield, you get paid monthly in cash. If you want to reinvest it, you just reinvest the dividends back in the principal, and it becomes like a consistent 11% tax-deferred growing asset. And when you want to get off the roller coaster to pay your kids' tuition or pay a tax bill, then you just withdraw your money or you sell, right? And for that to work, you can't have the volatility and the drawdowns of equity. You can't have the volatility, the drawdowns of Bitcoin. You need some credit instrument, and you need an issuer that's going to over-collateralize it, and you need to actively manage that credit instrument so as to create price stability. And so I think STRC, or digital credit, in my opinion, is the way that we draw the next cohort of retail investors into the space. And I don't know why we couldn't draw 10 to 100x as many. I would think, if 2 to 4% or 2 to 5% of retail were able to, by the way, if you find 5% of retail that like Bitcoin, they're not going to allocate 100% of their capital to it, right? They're going to allocate some portion. So I think if we got 2 to 4% the first go around, I think we'll get to 20 to 40% with digital credit. And I think that is in a way one of the killer applications of digital capital.
The first Bitcoiners were comfortable with turbulence. They saw opportunity where others saw chaos. But the broader public tends to move differently. Most people want progress without constant stress, returns without dramatic swings. The next evolution is about widening the doorway, soften the extremes, introduce steadier mechanics, and make participation feel practical rather than radical. When innovation becomes easier to hold on to, not just exciting to chase, adoption accelerates in ways that surprise even the skeptics. When prices surge, optimism spreads fast. When they fall, doubt gets louder. That emotional whiplash is not a side effect. It is the engine. Assets that barely move rarely command attention. But when something updates in real time and swings hard, it pulls in traders, skeptics, believers, and media all at once. Activity creates interest, and interest creates liquidity. In modern markets, motion is magnetism. The more it moves, the more impossible it becomes to ignore. Let's watch more clips from the interview.
To be more serious, when Bitcoin is hitting all-time highs, there's a sense of exuberance, and all of the media turns positive, and it's glowing, and people are doing high fives. And when it draws down, there's a gloominess to it, and then people over forecast to the negative. I think that it's the volatility that drives the engagement and the interest and the speculation, and there's something to talk about, and they're talking about us. What they're not talking about is they're not talking about real estate on the Upper East Side of Manhattan. They're not talking about timber rights. They're not, like people they talk about all these non-volatile assets. Well, non-volatile assets means there's no news. And if there's no news, there's no interest. In a conventional company, you have information released once a quarter. So there are 4 times a year, 4 windows a year where there might be information where you might trade the stock. 4 days. And you're expected to not surprise the market, which means that if you're a well-run conventional company, you give guidance and then you hit the guidance plus or minus, and it's really not very interesting. And so someone could pretty much value one of those companies by making a decision once a year. So once a year I decide to buy or to hold a stock and how much to hold, and then no news is good news and there's nothing else going on, and that's boring, not liquid, not volatile. And then when we got into Bitcoin, we realized, well, we're holding this asset, and guess what? Our website updates every 15 seconds, Natalie. Okay, so think about this cycle. We went from updating the financial markets with material news every 12 weeks, once every 12 weeks, to updating the financial markets every 15 seconds. Okay, so yeah, you're going to have weeks where Bitcoin is going to be down. Every time Bitcoin moves $10,000, the company makes or loses $7 billion. Right? $1,000 is $700 million. Let me put this in perspective. used to be the company worked for an entire year to make $70 million. So every $100 fluctuation in Bitcoin is the equivalent of 1 year's work. What we've done is we have plugged a energy source, a volatility generator or an economic energy generator directly into the balance sheet. And the Bitcoin cycle drives a news cycle. The news cycle drives Bitcoin trading. Everybody is obsessing. So you're on television and someone's obsessing. Well, could it go lower? Well, there's someone who's a skeptic that's thinking, maybe I should short the stock. I think I'm going to go and take $100 million out of my piggy bank and I'm going to short it $100 million. But you know what? They have to buy that back, right? Unless they're lucky enough to short a stock which goes immediately to zero forever. It's only a question of when are they going to have to buy $100 million back, right? They're going to have to buy it back. So you're attracting some group of people that want to trade short, but there's another group of people. They're like, well, this is totally overdone, and Bitcoin is definitely going to go back to where it was. And so I'm going to get in and I'm going to crack my piggy bank open and I'm going to buy $100 million. Now, if you didn't have the volatility, the short seller would have not bet $100 million on your company, and the long player would not have bet $100 million on your company, and the market makers in the middle and the options traders, they wouldn't have traded both. And then the Susquehannas of the world, they can create derivatives. I'm going to give you a call option to go $100 million, but only post $5 million in collateral. I'm going to give you a put option so you can go $100 million short and only post $5 million in collateral. I'm going to make $1 million doing that either way. Everybody's making a financial market in this. It used to be the Wall Street Journal. They would only write about you if you're a public company. They don't write about private companies. Why? Because because every story is irrelevant. I can't buy or sell the thing I'm reading about. Why would I read about something if I can't buy it,
can't participate,
sell it, leverage it, gamble on it, make money off it, right? Now, the word is interesting. The classic word in the English language for I have an interest in that company is I own. I have an interest in the company means I own X percent of the company. I have an interest in the company. I've shorted it. If you're short the company, the last thing you want to read is good news. It's terrifying to you. So someone says, oh, some great thing just happened at Strategy. Okay, you got to read it. If you have a long interest in the company, what you want to hear is good news. Okay, the Bitcoin price doubled, right? How do you make a company interesting? Okay, well, first of all, you take it public. But that's first order interesting because now there's a ticker. But I just illustrated if you're a well-run conventional public company, you're only interesting once a year or once every 12 weeks because you never say anything otherwise. So, there's news one day out of 100. 1% of the time you're interesting if you're a conventional company, and you're not supposed to be that interesting. You're supposed to never surprise me. So the number of companies that can surprise me to the upside every quarter, 40 quarters in a row, Natalie, that's 1 in 100. So 1% of the time you're interesting, and 1% of 1% of the time you're interesting in the right direction, which is 1 in 10,000, right? 1/100th of 1% of the time, will that turn out well? Okay, that's the conventional playbook. Now, how do you take a company and make it interesting every day? How do you make it interesting every 15 seconds? You take it public, then you put a lot of Bitcoin on the balance sheet, and then you let the Bitcoin vibrate, right? Oscillate. And that makes the company 100x more interesting? No. 1,000x more interesting. Maybe 10,000 times interesting.
Bitcoin is back in the pressure cooker. After nearly 3 weeks below $75,000 and a sharp retest near $64,000, nerves are fraying. Trade tensions are rising again. Tariffs are back in the headlines. Global equities are wobbling, and investors are instinctively rotating toward cash and government bonds. On the surface, it feels like classic risk-off behavior. Crypto dips when stocks dip. confidence shrinks when macro uncertainty expands. But history tells a more complicated story. During previous waves of macro fear, especially when trade wars or systemic stress forced policymakers to intervene, Bitcoin initially sold off and then reversed hard. Liquidity injections, even indirect ones through funding markets, have repeatedly coincided with major trend inflections. The 2020 crash is the obvious example. Panic drove prices down more than 50%, only for that same period to mark the foundation of a massive rally. Those who dismissed it as broken were left chasing it higher months later. Today, miners remain resilient, with network strength fully recovered and new generation hardware still profitable. Meanwhile, professional traders have quietly shifted from net short to net long exposure in regulated futures markets. That matters. It suggests dip buying beneath the surface. Michael Saylor has long argued that volatility and macro stress do not invalidate the thesis. They amplify it. If liquidity conditions tighten further and central banks respond, the setup for a reflexive move back toward $75,000 is not fantasy. It is a pattern we have seen before. As we wrap up, are you trading the swings or positioning for the structural shift? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.